Well, good afternoon, everybody. I am very excited to be back for this week's episode. We've got two great guests actually on today, and I'll introduce them in a second. But first, I just wanted to thank Raphael, who was the guest host last week. Did an exceptional job. You can tell he's a true professional in the podcast space. And Whitney, the guest, was awesome and provided a lot of insight. So thanks to everybody that tuned in, and particularly thanks to Raphael and Whitney. This week will be very exciting as well because I've got two guys from Patriot Holdings, Jeremiah and Tim, are actually going to do a full walkthrough on a recent case study that they've done on a new industrial development in a town called Summerside. It's a small town. I did a little bit of research on it. I think it's about 10,000 people in it. It's in New Hampshire, so I'm going to have to get them to actually give us a little bit more insight on that. And we're going to walk through some real numbers in there as well. So we'll go through the site plans, the budget, some of the due diligence they did for their loan origination, as well as the details on the loan that they were actually able to secure. And we'll just have a high-level discussion, as well as diving deep into some of the details, high-level about industrial in general, and diving in specifically to this case study. And I'd encourage anybody that's tuned in, please feel free to ask any questions. Jeremiah and Tim are happy to answer anything they can about this project. And if you're tuning into this afterwards on the audio version, you might want to come to the video because we do have some slides that we'll be sharing throughout this as well. But with that, I am pleased to have Jeremiah and Tim join me on. Gentlemen, thanks so much for joining me on the call.
Thanks, Chad.
Yeah, thanks, Chad.
Appreciate it.
So this is exciting because I think doing an actual case study on a new industrial development is going to be very insightful for a lot of people that have wanted to do developments themselves or just curious about the process. But before we go into the specific project that you guys are going to present, I just want to get your sense on why you like industrial in the first place, and particularly why multi-unit industrial versus a big warehouse.
Yeah, Chad. You know, we follow you for quite a while here watching the show, and we always wanted to break into industrial. We come from the storage background. So we decided, for us to get into that space from the region that we're growing our storage company, we would see a lot of demand for small contractors, just kind of flex office space, warehouse space, where there's no supply, very little supply in our markets. And it mirrors self-storage to a degree where a lot of the projects we're building are metal buildings, steel frame. So Tim and I, got together years back. He had a building background where we noticed there was a gap in the market. There was really no supply out there. And in the Northeast, especially, there's a lot of need. There's a lot of trades guys where the core industries aren't controlled by one big company or a handful of big companies. There's multiple towns spread out over all type dense population area where these trades guys, typically did what their father did for a living, and they need space. And also, economically right now, these guys are in demand with post-COVID and with housing being where it is and the shortage and just labor in general, they needed space. So we noticed that from even the last 3 years, and listening to what you share on your podcast there, we saw rents really creep up the last 12 to 24 months. So when we bought this asset, we projected a certain amount of rents, $8, $9 a square foot, triple net. Now we're easily at $12 triple net plus. So it really incentivized us even more where, one, there's a demand for the product, and then two, economically, it still makes sense. So we're taking a big push into this where we'd rather build new product rather than buy old, deferred, either heavy deferred maintenance or capital expenditures that are needed in those products that really don't even serve the greater good or really the needs of our customers. And then also be able to charge somewhat of a premium right now because there's just no space.
Yeah, and I love the point you made about just how there's demand for a lot of these smaller bays, because I think that that's a misconception in the market, is that the industrial real estate market serves these big 1 million square foot distribution centers, when in reality, there's the full spectrum all the way up from the 1 million square foot buildings all the way down to a 1,000 square foot industrial condo, which is suited for smaller companies that still need space. So it's interesting that you guys are carving out this niche, because I think that the average investor, this is a space that they could benefit benefit from versus being overwhelmed by the prospect of having to look at a 1 million square foot building and the price tag that comes with it. So when you got, and it's Somersworth, the name came to me after I stumbled on that one because I'd never heard of the town before, but it's about 10,000 people. I wanted, before we get into the details of this, why did you pick that market, Somersworth, and what size are you targeting when you're looking at these multi-tenant bays?
Yeah. So, Chad, on that, I would look at it where, your town is 10 to 11,000 population, but then the 5 mile it's Dover, New Hampshire, Rochester, New Hampshire. So there's a large college, UNH is there. So I'm from the area originally. So there's 30,000 people within our little MSA, 30 to 50,000. So I think 10,000, if you're on an island and you're like out west where you're in a small town and that's all you can draw upon, I'd be very hesitant to build in that market. But in this market, number one, there's high barriers to entry where it's very difficult to buy flat land that doesn't have a lot of wetlands, doesn't have a lot of topography, that zone commercial, that would allow for metal buildings. So we like that barrier to entry. And then we also like, that density around it where we can tap in from the 5 to 10 mile radius where you're at well over 30,000 people in that range. And your other question, I think the reason that we went with this project is we wanted to de-risk ourselves where it actually wasn't a pure ground up vacant piece of land. We deleveraged our risk with the approval process because that was our most concerning, where you do all the due diligence, and if the seller doesn't work with you on your timelines, you close on this piece of land and then you can't build what you want to build. But what we were able to do is it was actually on the market. I mean, it was on LoopNet, on Crexi. It was a 2-unit, 2 separate metal buildings, where on the front of it there was an existing building that it's a dance studio for kids. And actually, we bought it before COVID, and it did quite well actually through COVID, where kids needed something to do, and they did these outdoor events. And they had a 10-year lease, and they continued to pay on their lease. And then behind it, there was an ambulance dispatch company where they maintain the ambulances, and they do a lot of the different hospital transportation routes for these rural towns that go into Boston or some of the bigger hospitals. So we had it in place on the rent roll. We had 2 tenants on there, and then the value add, we bought that around a mid 6 cap, maybe 7 cap on actual income. And then the back had 2.5 acres, and that's where we saw the value add, where it had the industrial development use zoning. So yeah, at that point we hired the engineer that was already on the project, and that was a big mistake. And Tim could talk about that on that side. But basically, that 2.5 acres, we were able to get 40,000 feet. And that was big enough for us. So we suggest anyone to have, I think in storage, about 40,000 feet's your kind of break-even point where you can get some scale on the project, where it's worth the management. It's worth actually getting your contractors to do the site work, where your costs actually fall in line with where they should be, rather than it being a small project where certain costs outweigh the ability to actually make it profitable. So it had the best of both worlds for us, where we could get the square footage we needed, had existing income, had the actual zoning that we needed. And that's why we decided to move forward on this one.
Yeah, there's a huge difference between having existing cash flow support that project as you roll it out versus buying a piece of land and having to do a ground up development with no income coming in. So I know a couple guys, even in my own local market, that have done similar types of projects, and they've done very well by it. Beverly just joined in and said, hi, Jeremiah. Tim's also here, Beverly. So hi to you, and thanks for joining in. Tim, or Jeremiah on your behalf was going to talk about a mistake hiring the engineer. And I love exploring anytime there's the word mistake. I love exploring that further just to get to the bottom of what it was. So what happened there? What went wrong?
Yeah, well, our engineer, like he said, was working with the prior owners of maybe expanding and doing industrial in the back. And so we thought, hey, he's already done the survey. He's done all the site work. He's familiar with the site. He's worked with the town. Let's stick with him. The problem was he really wasn't familiar with the product we were trying to build. So there was a lot of issues on what he, drainage wise, how he built the site. He really overdeveloped the site, which cost us a lot of time and money. And then how he presented the site to the town actually triggered us to go to state and go through a Department of Transportation, even though it was existing kind of entrance exit they were going off of. But how he presented the site to the town triggered this, and that cost us about 6 months on our approval process. So there was a lot of lessons we learned. We have a couple engineers that we're familiar with and that we work with in the New England area, and if we were to do it all over again, we'd probably stuck with them and do what you're familiar with and who we have the rapport with. But we got it through. It took about a year longer than we wanted, but we got it approved and started construction about 2 months ago.
And to that lesson, Chad, just so that the listener understands what the actual issue was, is if he could have framed how much traffic really was going to be going in and out of this property, where it wasn't a high, it's not a retail use, right? It's not a heavy use in terms of traffic counts. Yeah, that we wouldn't have needed the DOT to come in and cause us to build a deceleration lane on the abutting highway, but it's really just a 2-lane road. And that could have been proposed differently, where the load, the parking load, the traffic load is not as high as what the town thought. And then that would have bypassed us having to go through the state DOT to get that access deceleration off the highway. That was a big mistake.
So there's something I want to just unpack on this a little bit, because I think anybody that has bought real estate, and we're focusing on industrial, but I think anybody involved buying any type of real estate, there's going to be some professional that's tied to that building. In your guys' case, it was an engineer. It could be all types of things. There could be an architect that was tied in there. It could be a service provider. And I think it's tempting as an investor, a developer, to just inherit those professionals because they already have a familiarity with the project. You think that there's upside to someone not having to come and learn everything from the start. So in this case, was it a one-off scenario where this engineer just wasn't correct in how he was establishing this, and it would prompt you guys to bring in your own team regardless of who the future engineer was, or was it just like that one-off scenario?
Well, in this case, so for the viewer, he had the survey completed, so we would have used him for the Alta survey, so that way we know our topography, our setbacks, we know the easements, we know the boundary lines. Like, that's fine. Like, right, he could do a decent survey. The challenge was, like Tim said, we should have done a little more research in terms of what are the projects that he's got approved in the past. And he didn't have small bay industrial on his track record, at least in the way that we were going to be building the project. So we should have went with another engineer that either went from farther away, where we could have hired maybe a little more expensive, but specifically built small bay industrial in the region. And it would be nice, though, if we actually found there was a few products that were built in the town and they actually worked with that town before and got approvals. That would have been the way to go, is to actually work with somebody that already has an existing track record in that municipality for that product type.
Love it. And there's the huge nugget of wisdom, I think, is that don't just implicitly assume that the person that is familiar with that property, whether you're buying something new or doing development, don't just assume that somebody that has history on that specific property knows enough to deliver what you need them to do, but actually do the same process, whether it's that engineer or someone that you already know, on what their experience is, as opposed to just assuming that they're the correct person. Is that a good way of highlighting it?
Yeah.
Okay. Yeah, no, I love that, because I'm definitely guilty of that to myself with projects that I've done. Is it's easy, right? If somebody already knows the property, the process of having to bring someone else on, get them up to speed on the property itself just takes time. But in your guys' case, it would have actually saved much more time had you brought the right guys on from the beginning versus all the hurdles that he had to jump through. And Matt, thanks for joining in the question. He asked, how did you solve the traffic issue? Did you have to do a new traffic study?
Well, we did. We went back and got a traffic study, but then at that point, so we were able to get rid of the deceleration lane off the highway, which was great. But at the local town level, they made us put another kind of exit lane on site, which worked out for us. We didn't have to deal with getting bonded for going to on the public roads. We didn't have to go through that state DOT permit to the end. So we just had to add some site work on our site, and that's how we got around it.
Cool. Okay, so let's jump into it a bit here then, because you provided me a ton of information, and I don't like. You guys are very transparent with this as well. For people that want to dig into this more, is it possible that we can put this somewhere so that they can view it as well?
Absolutely,
of course, yeah.
Okay, I'll upload it to my website then, and I'll put a link in the comments so that people can actually download these. I really do appreciate you providing these, because I think that there's a ton of insight on how you guys went through this. So Wyatt, if you're able to, can you pull up the first one, which is the site plans? And again, if you're tuned into this on audio, I'll put a link to these so you can actually download them. Similarly, if you just want to have a reference of these, the budget Excel spreadsheet, I think, is also very helpful for people that just want to know some of the hard and soft costs that you're including in your budget. Wyatt, if you could scroll even up to the top, just so people have perhaps that is, oh yeah, okay, perfect. So here's a site plan for how you guys are doing it. If perhaps you just want to walk through and Wyatt, as they're going, if you want to flip to any page in particular, just you can give us an overview of how these are built from an engineering and architecture standpoint, with the understanding there's already 2 buildings on there. This is on about 2.5 acres of surplus land that you have, but I'll let you guys give an overview on it.
So I'll give you the layout, and then Tim can give you the actual construction. So the way that we could maximize this site, there's typically a coverage ratio that you can't exceed, where in the Northeast, you can't, every town's different, but normally you can't exceed 50%. And sometimes it's even 35% of impervious surface area. So the water needs to drain into the ground because the water table is quite high out there. So we came up with, we maxed out the surface area on the amount of buildings that we could build. And what we did is, in this particular case, we wanted to make sure we had enough versatility with the unit mix, where it's 40 feet deep and 20 feet wide. So that would give you an 800 square foot unit per unit, but there's no demising walls. There's no that. So we're able to, Tim will share the red iron steel, the big open floor plan, but we can make it as flexible as possible, where if we actually ended up condoing these, Chad, where each unit, down the road, if we wanted to sell them to each individual tenant, we'd have the ability to do that. And then, so obviously the one building on the front side of the development, that's one side access where we have the contractor door and a man door. And did we go with 14-foot high garage?
14-foot high.
Yeah, and we ended up going with the 14-foot high garage door, so that way even a semi can pull in there if they need to work on it. And then the other 2 buildings are complete drive-throughs. They could go all the way through, and you could have 80-foot units. But what the big key is we wanted to maximize parking as well, because everyone typically has some employees, and some of them have fleets of trucks, so we were limited on parking in here. So we try to maximize parking, plus like a flexible layout in terms of a user taking a small amount of space, 800 square feet, which we can get a higher rent, maybe even $13, $14, up to the whole building. Where was it? Up to 10,000 feet, right? Or
yeah, the 80-foot wide by 160 span. So
we're pre-marketing it now, but that gave us the most flexibility, where I would, if someone were to do these on their own, the long, narrow buildings where you have, 40, 50, 60-foot depth, or even up to 80-foot depth, that's pretty nimble for the guys to be able to get access in the front, access in the back. And it's all grade level doors. So we really didn't have room on this to have loading docks, because we didn't think that, the size of these buildings, you're not going to get a lot of warehousing or a lot of distribution out of here. So this is mostly for just guys that are in the trades, and they get a bathroom. We'll have a bathroom stubbed, and they have their, they can take as many as they want in terms of, if they get 4 units, they can get 1 bathroom built or up to 4 bathrooms built. But that was the reason for the layout. But Tim can share, the type of building and why, with the cost and everything else around it.
Yeah, and just before you jump to that, Tim, one question about what was your process on how you determined that this would be the right fit for the market?
Feasibility.
Well, yeah, the feasibility study, there was a new development. There was a conversion of a large industrial warehouse into these small bays about 2 miles away. And they were leasing rapidly. So we could see that there was a heavy demand. We're near a highway that has access to the coast. It has access to the mountain region. It has access to the highway leading to the college. So it was only about 2 miles or less from the highway exit. So we wanted it was specifically geared for small contractors. So that 800 square feet on the low end, all the way to 10,000 square feet, that filled that void of what you were sharing, Chad, where a lot of investors or developers, they're not going to deal with tenants under, 10, 20, 30,000 feet or even under 100,000 feet. So that really targeted the small industrial user. And that was pretty much the smallest space we could provide unless it would be self-storage. So this is it. This is the smallest area for industrial.
I love it. I think it's such a great project that fills a void in the market where all these companies need product, right? If it's a plumber or an electrician or anyone that's even just needs overflow storage, there's demand for this in every market. And for the most part, there hasn't been a lot of new inventory added. So I love how you guys have proposed. Well, I have this underway, but also how you even condoed them, because that's another great exit strategy at some point down the road if you wanted to sell them as individual units, or if you want to sell it as a leased out package. I think it gives you a lot of exit strategy. So kudos to you for this. Tim, if you want to expand on the design and the construction, and if you want, Wyatt can scroll through here to a certain page as well.
Yeah. Another thing is, we look at a bunch of different projects, and we do like the single tenant 100,000 square foot buildings that works, and something we're looking at. But we do like the fact that here we have multiple tenants. So if you lose one tenant, it doesn't hurt you too much, right? Like you got 20 other tenants that are going to make up for the difference. So that's what we kind of like this project. And on the construction of it, like these buildings here, we went with Star Buildings as the manufacturer for these. It's just red steel structural full span, so you have no interior columns or anything like that. It's fully open on the inside. Like Jeremiah mentioned earlier, we left it open so that if someone wants 800 square foot space, great. We throw in a demising wall there. If they want to take up 3,200 square feet, we can do that. So that's how we left the design, with no interior demising walls to start off. And as we get the users, that's when we start building the demising walls. For plumbing, electrical, what we've done is we've actually put a master meter on each building, and then we're going to go digital meters to each space as people take them. So if someone takes the whole building, all you need is 1 meter. If they take up, if we have 4 people taking up one building, we'll have 4 digital meters, and then we do a bill back of the utilities.
And we're managing that, Chad. So we're going to manage the association for the condo. I mean, we're going to own all the units. We're not sure if we're going to sell them, but just to make that clear to everybody that, we're the property manager on this project.
Right.
Yeah, very cool. So I want to move on to the budget, because I think that there's a lot in there. But Wyatt, if you can, real quick, just before you scroll over, can you just scroll through that document? Because I just want people to see what's included in here. So put a link to download these so that you can get a
and when you look right there, Wyatt, it's just when you're looking at that topo plan, like you really want to look at the elevations. And that's what, Tim's taught me since he's worked with me here is, you don't want these heavy elevated grades. It's just your site work's going to go through the roof, and that's going to eat up a big cost with your site work bid and your grading. So people need to work in the beginning. I would look at very flat. Now you don't want it pancake flat. I mean, you do want 1 to 2 feet of a foot of elevation every 100 feet or a couple hundred feet. That way you got drainage. But that was the ideal site for us, because it was the site work was already done in the past.
Yeah, you need that Goldilocks layout where it's not too flat and it's not too steep, but just so that you have the drainage and not a lot of site work cost. So I really appreciate you guys willing to share this, because for people that want to go through this in more detail, it'll give them the ability to see how much planning goes into this process. But with that, if we could go to the sheet number 2, which is the Excel spreadsheet, Wyatt, and that's
clear. It's a civil engineer does all this. So in these pre-engineered buildings that we buy from Star or any of them, they already have their architecturals
and
structurals.
Yeah, and we'll see that too as we go through these, and we won't go through it line by line, but you could even see your architecture cost. I believe it was $60,000, but your engineering cost was considerably more. So that's where that bulk of that went in. Maybe what we could do, because I don't want to do line by line on this, because I think that could take us an hour by itself, but we'll provide this Excel spreadsheet for anyone that wants to dive into it deeper. But one thing that I know from the projects that I've been involved in, and I'd love to get you guys who've done considerably more to elaborate on it, is just even the difference between soft costs and hard costs, and how soft costs can often creep up much higher than people anticipate.
Yeah, absolutely. And for us, This site was actually a little easier, like with the soft cost, because the engineer, like I said, was already involved in the project. But we get some developments that are raw land, and we'll spend $80,000-$100,000 on civil engineering. Architectural structural costs can push $120,000 depending on what you're developing. So depending on what you're doing, those soft costs and just your design creep up pretty quick, right? The soft costs, in our general conditions, some of it's hard costs, some of it's soft costs for supervision and management and cleanup. But it's really on that design, watching the design cost, and then any kind of permitting cost. In some towns, like this one was really light. Some towns, the permitting costs can exceed 100,000 depending on what you're doing. So definitely look into that while you're doing your diligence before you get started.
Well said. And when you guys design this spreadsheet, and I know it might be a bit hard to see on the screen, so I hope you can just kind of follow along with us as we're going through this, and then perhaps just download a copy so you can go into it in more detail. But when you guys were putting this budget together, how did you determine all the line items that you would need individually, as opposed to grouping a few of them together? And then I've got a follow-up question on that as well, is how do you actually determine the values for each one of those line items?
So we try to get pretty granular on breaking out our CSI codes for everything we're doing, and that's where, so we're taking the big ticket line items and breaking those out. And one thing that's not attached in this spreadsheet is we have a true kind of schedule of values tab that we budget off of. So when we're doing the feasibility, we're looking at it. We'll get a conceptual drawing from the engineer, and we'll take our schedule of values of which is like per square foot price, per linear foot prices on a lot of these line items, and we'll throw a budget together, and then we'll do a comparative to, once we get hard cost, which is built out on this sheet, to what we have done on our schedule of values on our bid sheet. So yeah, we try to get pretty granular on the line items. And then on the second question,
just in terms of frameworks, Chad. So people, it's tricky in the beginning, right? Because your region might have different costs for each different cost code. So for us, it took a little trial and error for us to understand what each item would cost us. I know RS Means, they have, that's a website.
Yeah, to get average square foot cost. And for us, what we've done is we've taken our previous experience in development, and we know in a region, a sub-region too, like, hey, we're paying $850 a square foot on concrete, or we're paying $21 for the buildings and $4 for the erection of the building. So ours has just been through, but RS Means definitely is something good if you're starting off to go off and get pricing off of.
But the site work's all over the place. So really that one, you're going to have to put the bid out, right? And then you're going to get at least 3 bids and local contractors, because you really don't know. So it's tricky in the very beginning to really pin that number down. But if it's a flatter site with drainage, you'll be okay. At least coming up with, I don't know. I mean, you could kind of give yourself a certain number per square foot, but we can give you guys a breakdown of what we use in terms of, just ballpark ranges on each item. And then they got to get super specific from there to the project.
Yeah, that makes sense. And that requires a lot of reconciliation. I'm assuming at some point down the road, just to see what the actual versus the budget was. And to that point, you're probably building in, I think I did see a contingency fee in there. What do you typically allocate for contingency?
4 to 5% typically on our contingency is what we're using.
Cool. Okay, well, yeah, I love this spreadsheet. I think it'd be very helpful for someone that wants to explore development in more detail. And
Chad, on the building side too, the Star buildings, Tim and his team, they shopped a lot of different building manufacturers around the country. And with steel prices going up so significantly the last 12 to 18 months, that was a really important piece of the puzzle to find the right manufacturer that can deliver on time and still deliver on budget
and hold the cost.
Yeah, they held the cost where they didn't give us that cost overrun or that change order when it showed up on site. So we can also share that as well, where they're domestically based, but they came in and actually pulled through for us.
Yeah, and that's so key right now because a lot of contractors aren't holding pricing, and in some cases they'll only hold it for a week or two. So to find someone that will honor the price from the time you conduct the order until it's actually on site is pretty important. And I'll leave your guys' contact information near the end of this. We'll go over that as well for anyone that wants to reach out and discuss either construction or investment opportunities. We'll chat about that at the end. So I appreciate that reminder as well, and that, Jeremiah. And you guys essentially took the plans, your budget, and you proposed this for securing a loan. So whether you call it due diligence or underwriting, different terms for different parts of the process, but this was the template that you provided to ultimately get loans. And we'll talk about the loan that you were able to secure as well. But go through this process on how you designed this document, what the thought process was for, and then ultimately what it was used for.
Yeah, so we're big proponents of using a loan broker. I know you've had a few on the show, Chad, where we want to shop lenders, banks, to get the best term that we can. So we can share our loan broker. He used to be with Marcus and Millichap. His name's Alec Neacham. So he goes out there and he shopped this loan for us, and we were able to get a local lender. But what he did is just took our budget, took our pro forma, our real rudimentary Excel spreadsheet, and then this was his loan package, or one of the pages on the underwriting, to the lender. So the loan broker did this, and what we projected was, based on occupancy out there and based on the appraisal, there was very low vacancy here in this market. So the bank required a 5% vacancy number. Over the last 12 months, rents hiked up to $12 triple net. So we projected, well, in the beginning, we projected a little bit less actually, but we were able to, during the market, show the bank that, rents are at $12 a square foot triple net. And, it obviously pencils out really well. We had a structural reserve that was required by the bank at 10 cents a foot annually. So at the end of the day, we get a net operating income of $433,000. That allows at a 6.5 cap. I think we're at roughly, they're projecting it at 7.25 here. So that our value would be close to stabilized value just on the construction portion, around $6 million. And our cost to build, as you can see there, was $3.8 million. So I think that's a very conservative evaluation right now, even with interest rates increasing. So we created $2.2 million in value. And then also we still have the original asset that we bought, which is worth roughly $1.8 to $2 million. So, we created a project that was worth $8 million, and we created equity of about anywhere between $2.5 and $3 million after it's all said and done.
Yeah, that's a great project. No one can deny how successful that will ultimately be in your guys' world, because you've got projects all over the place. Is this a single, triple, home run? What does this look like when it's all said and done?
Double.
Yeah. It's a solid. It's a lot of work, right? Chad, is from the time this thing has taken a year longer than we expected. Our construction budget, has increased by just other factors in terms of site work and labor. That was up an extra 20%, 10 to 20%. So it's been a challenge. So we're all in at about $95 a foot on the construction, our cost to build, and that's with our developer fee and the soft costs, excluding the land. So that is our cost to build. So that was a little bit more than what we thought. But at the end of the day, the value's at roughly $150 a foot or more. So yeah, it's well worth it, but we still have to get it over the finish line and lease it up. But I would say that, because we deleveraged the risk and had the existing cash flow in place, that gave us a lot of comfort when COVID hit and when the costs were going up, and the bank even hung in there because we can continue to, we didn't draw on the construction loan, but we still had incoming going in on the asset. So that was a real important component of this deal where we didn't feel like we took too much risk.
Interesting. So the next slide, Wyatt, if you can pull up just the loan that you guys were able to secure on that basis. If you could zoom in. Oh, perfect. So with that up there, anything to add on those loan details there?
We were able to go back. So you see our loan says 95% original hard cost. So when we originally budgeted this, 2.5 years ago, we had budgeted for about $2.7 million construction for this project because of where steel price was. The original drawings we had before the civil engineer did a redesign on the site. So we did go back just recently, and we've kind of upped our loan based on the new value of what the exit's going to be on this. And so we're actually our loan now is going to be 3.5 million, which ends up being like 92% of the original hard cost.
Which is phenomenal, Chad. Yeah, I mean that was so. Yeah, really, we're about 30% higher than we were than 2.5 years ago. So that was they came to bat for us. We bank with them. We're very loyal to them. We don't always have the cheapest rate. So that 4.5% rate was two years ago. So we were willing to, when the rates were in the mid threes, low threes. We really liked this bank because they understood the project and we were doing ground up construction. That I think for the listener, we weren't really worried about rate sensitivity. That was a fair rate, but the bank was willing to work with us through all these challenges. Plus they gave us that 2 years of interest only, which came in handy right now for us to help us finish the project, which a lot of banks sometimes only do 12 months of interest only for some of these smaller regional banks. And then at the end, we perm out into the 25-year amortization. And what also is good about this bank is after the 5 years, they will, even if rates, the rates readjust, which they are right? Rates are a lot higher. They at least will extend our loan out another 5 years. And it's not a full balloon where we just get shut off and we have to go find the money to refi out. Because if all hell breaks loose and the capital markets get a little tight, we at least can refinance with the existing bank and at our current loan amount and be able to be in at a good basis where we have a loan on the property and it will cash flow even if rates are at 7 or 8 or 9%. So that was important for us that loan continues to term out long term where we're not shut off, where we're running around trying to find another loan to replace this loan after 5 years if markets go bad.
A very good insight on that. Wyatt, if you don't mind closing down the slides and then also just bring up that comment from Matt, because this actually ties in to the next part that I had. Curious if there's any office with those units or just a restroom. So you did mention that these are just wide open, but there will be stubs for the washroom. How do you treat the scenario where a potential tenant comes in and they need an office? Are you giving them a TI? Did you budget for a tenant improvement allowance, or are you just going to amortize that into the lease rate?
Yeah, so we did budget for a small TI for actually doing an office and a bathroom when we were underwriting originally.
In the $95.
Yeah.
Yeah.
So we did underwrite to have to do something small, but what we didn't want to do is go out and build these out and limit ourselves to now someone has to take a space that's only 800 square feet. So we run all our undergrounds off for our plumbing. Everything's gonna be stuffed up there. Water's overhead, right? And then once they figure out, hey, I want 1 unit, 2 units, 3 units, and then they'll come out and we'll work with them on kind of an allowance of, hey, what do you want? 1 offices, 2 offices? If you need 4 offices and we're building out more, you might have to come to the table. Your lease rate might be a little higher, or you might need to come to the table with a little money. So we have a design, and we're actually. Once we're built, we're going to build 2 spec units with what it can look like with, just a bathroom or with an office and a bathroom.
Okay, that makes sense. Matt, if you had any follow-up on that, please just add it in. We'll get to that too. One question that I always have on these small bays is just the creditworthiness of the tenants, because by nature, these are small companies. So you might have that proverbial man in a van who's just a one-man operation. He's a spot to park his electrical truck, all the way up to some more small, well-funded small businesses, let's call it. What's your underwriting process to evaluate the creditworthiness of these tenants that are going in here?
Yeah, so we're really keeping our mind open on our tenant mix. So we understand that they're not going to be credit, first off. So our underwriting criteria, how many years have they been in business? That's number one. So if they have an established business and they actually were even if they were working from home or out of a garage at their house, if they've been in business for 3 to 5 years and we can see 1 or 2 years of tax returns that they're actually generating revenue, to us, that makes us feel pretty good. Secondly, we prefer if they could show, cash in the bank, not their personal. I mean, if they run their business out of their personal, we want to see that they have somewhat of a substantial amount of money in the bank in terms of just some capital, $100,000, something where $50,000 to $100,000, just to have some operating capital for their business. So that way we know they're not going to, shut the lights out tomorrow. And then, lastly, it's really, understanding the concept of the business and making sure it's viable. If they have something where we still want to treat it like we're like a bank would, what you're doing, is there a demand in the marketplace? If they're selling tchotchkes and it's, it's kind of a nonsense business, we don't want to take that risk, and build that out for that person. Now, it might be different if it's just turning over and they're getting a new space, they're just leasing an 800 square foot space, and we've already have it built out. But our initial underwriting, they're going to have a viable business for us to allow them in. But one point, Chad, is, actually we thought we wanted 5-year leases, and now the brokerage community just changed our mind around that and said, hey, with inflation so high, stick with your 1-year leases and let's see how these go. So we're actually, it's a win-win, because a lot of these guys only want to do a 1-year lease to see if they're going to be successful. And we only want a 1-year lease because we want to continue to adjust rents if inflation continues to increase.
Yeah, that really does speak to the trade-off of industrial real estate. And the benefit of some of the larger deals is that you can have that 5 or 10-year established cash flow that is with a credit company, and with pretty good certainty that that's going to sustain itself. But you also can't raise lease rates in the middle of a lease term. So the other side of the equation is when you have small bays like you guys do, you have the flexibility to give short-term leases on that. So I think that's another reason that people should consider these small bay industrial as options. And Matt had another question. We always like rent to be about 10% of gross revenue on the smaller guys. I'm sure you guys run in the challenge of evaluating these smaller guys.
Matt's spot on. Yeah. And that's just like if you own a retail center or a restaurant tenant, that's the same thing. We really don't like it, the rent being 10% more than the gross revenue that they brought in the following year. But that is a challenge, Matt. Sometimes they're growing the business rapidly. But, if it's the HVAC guys, paint guys, they got a little bit of a track record. We're pretty flexible with that because they are in such good industries right now with the trades. So we're comfortable going a little bit higher than that.
Is the plan with this to keep this as a long-term asset, or how do you evaluate your holding period on a project like this?
Yeah. And Chad, just one point for the viewers. Also, we bought another industrial existing that was built in the 80s or mid 80s, and then another part in the 90s. And we inherited 70% of the leases were 3-5-year extensions. So there's 8, 9, 10, 11 years left on these rents. And we were just there this morning here in New England, and we're charging $5, $6, $7 gross. Wow. So that was, I mean, luckily we can expand it a little bit, but for the listener out there, be careful if you're buying these and you're getting it. We bought it at $55 a foot, right? I mean, we got a good price and it was a good quality building, but man, you are capped. It's like your valuation is only determined on, it's only as good as your leases, as your revenue. So we learned that lesson quick. So luckily we could expand, but how, to answer your question, how we actually evaluate the hold term, we looked at this, and at first it was going to be buy or build. We were going to build around $80 a foot, $85 a foot, and sell them for, hopefully $120 a foot. That was like our stretch projection, and we could get our capital back and go recycle it and go buy or build more. And then we started looking closely at this and thinking, oh wow, we have class A product. I mean, it's B plus, but it's brand new, so it's very low capital expenditures, no deferred maintenance. I mean, once it's built, it is built. And with rents that increase, from almost 35% over the last 12 months, the economics are, why sell it off now? Let's fill it. Let's hold it. Let's see where rents continue to go. And for us, we wanted that predictable cash flow model where we weren't feeding a lot of these older assets, especially in multifamily where we have our background in. So that was our determining factor, is just stability, predictability, and lack of actual supply. Like, we have a barrier to entry. We have something that's a good product that we don't want to sell out of. So we see long-term growth in this asset class.
Are rising interest rates scaring you guys at all right now?
I mean, we're underwriting a little different, but
yeah, it's different for, we listen to your podcast, and when you were doing a $25 million project and we're building it where the margins are tighter, or there's only one tenant that controls the whole asset, and as interest rates change, maybe that changes the whole economic picture where, if we're building spec, we can't get anyone to fill that space. That's a risky place in industrial for us. On this asset class, if rents go, we did the stress test. If interest rates go up to 7, 8, 9%, our cost basis at $95 a foot still pencils out where we can still hit a 10% cash on cash return. Now, we might not get our capital out of it right away. We can't refinance and pull out our money, but we get those nice double digit returns, and we're confident we can keep it leased. So we're not so rate sensitive on the smaller projects, but we're doing the heavy lift. I mean, we are creating value rather than just buying something and putting cheap debt on it.
Yeah, well said. So I guess with that, where are you guys looking for opportunities right now? What's catching your eye? Are there markets in specific? Are your heavy value add guys? Do you want to find similar projects like that where there's existing cash flow and surplus land? Is any markets in particular that you're looking at?
Yeah, what we think opportunities are going to come is, we obviously our main business is all-purpose storage. It's a storage company, but this is a nice ancillary addition to that business where about 20% of our customers are commercial customers and they outgrow small storage spaces. So our focus is still in the Northeast area, New England, New York, Pennsylvania. We're trying to move down into Maryland, but what we want to do is stay in that region where, we're going to, ideally, I think we're going to find permits come on the market where we're buying one in Massachusetts now where local guys will get them permitted. As long as it's over 40,000 square feet, we would look at buying the land with the permits, and we would rather just wait for these opportunities that come up rather than going out and buying raw land and trying to permit it ourselves. So because I think it's a little volatile right now, and because we have good banking relationships, we can step in and actually develop some of these projects that some of these maybe older developers don't have the stomach for.
Interesting. What type of premium are you seeing on the land that has already gone through the permitting process versus one that hasn't?
So the one that we're buying now off of 495 in Boston, we're paying $1 million for 40,000 feet. So that's buildable feet of exactly like we're doing on here. So that land, I would think we pay up to at least double the land value because of the value that's created by going through all the entitlements and the town restrictions. Now that is in the Northeast. If there's other areas like in Texas that are a lot easier to build, I wouldn't pay that premium. But in our markets, that's well worth the money.
So it could actually be an opportunity for somebody that wants to add value to the land by going through that permitting process and then selling it off, provided there is an adequate enough of a spread to justify the risk and the costs and holding period and all that as well. That's really interesting.
What I would suggest, Chad, is that when they're looking at their metrics, for us, $12 minimum rates right now are the low end. Like if we can't get $12 triple net in the market and there's not that buffer where that's the low end of the small bay market, we don't want to go build in that market. With construction costs, it's just the metrics don't make sense. So if you can be closer to MSAs where Boston's now $14, $15 and maybe even more in some areas. And we're talking metal buildings. So that's the thing too, is the economics for metal buildings. You can do a little facade upgrades, and Tim has to deal with some of the ways that aesthetically the towns want them to look. But the core metal building, you got to have $12 or more rents for us to pencil it.
That makes sense. I love how you guys go through that process on it. And I want to get a little more info on Patriot Holdings. And you mentioned that how you and Tim came together, but what's the story on Patriot Holdings, on how you guys got started investing in property to where you are today, and the outlook for the future?
Yeah, real quick. So I grew up as a kid in New Hampshire. My mom split up my dad. We went out west to Vegas. I met Tim when we were in grade school. We played soccer together, played football together in high school, and then we went off our own separate ways. And Tim was in construction for 15 to 18 years, and I was in real estate for 15 to 18 years. And we kind of merged, 4 years ago. And, I was getting out. I was in manufactured housing, and that was a great asset class, and it still is. But I was just beating my head against the wall operating that product. And I was just ready to step away, where I thought the market's saturated. Well, not saturated. The market's overvalued. And I started selling that off. And Tim came in and said, I can help you operate some of this stuff. We can build this stuff. And I was looking at self-storage. And we really just decided, okay, we're going to make this conscious effort to get into storage and warehousing. And that's when we went all in. We put all the chips back in, right into the next business. And our goal is to build all-purpose storage into ideally a top 10 storage company in the country, and really diversifying with commercial, small bay and being a product type in addition. And then from there, continuing to raise. We have a series of funds that we raise in, and we keep it tight. We're not a fee-based company where a private equity firm that makes money on just allocating capital. I mean, what we do is these types of projects where we buy these projects where we can really add value by management, by construction, by really knowing the insights into the market. And that's why we came back to this region, just because we know it really well. We bought a lot of product in the area, and then we started finding pockets where we could build. So I just want everyone to know, don't just go build something. You got to know your market in and out. And we bought existing product way before we started building ground up. So that and Tim can share, why he did it, but I got him in this mess, and now he's stuck for life.
Jeremiah, spot on with what he's saying is, I was doing general contracting. I owned my own company, flipping homes and doing all that. And he talked me into joining him and coming on board and really kind of building this out to what it is now and what it's going to be in the future. So it's a lot of work. We all know that. I mean, anybody that does development or any kind of commercial real estate investing knows it's a lot of work, but it's well worth it. And I wouldn't change it for anything. I love it.
Yeah, it's been awesome getting to know you guys, and I really look forward to continuing the conversation down the road on this. I know it's very difficult to try to distill all the knowledge you've accumulated in your various career paths down into like a soundbite. But if you were to give advice to somebody that's the junior version of you guys, they either want to start investing or they perhaps own a portfolio and they want to start developing, is there any high level tips that you would wish that you knew when you first started?
So during COVID, I tucked myself away, and he took the reins, and I wrote a book. So it's called Finding Your Edge: How to Win at the Game of Commercial Real Estate, and it's on Amazon. But Chad, I think essentially what I came out of that is finding your value in the deal. So finding how do you create value, and what I mean by that is, for me in the beginning, I went out and found an undervalued asset class, which was manufactured housing. And like we're talking about now is small bay industrial. So I wasn't competing. I had an edge in the market. I wasn't competing against a million different manufactured housing guys, because it wasn't a big asset class at the time. It was not sexy at all. And, right now, Tim and I, we're building small bay industrial. I mean, we're not going to make $10 million or $20 million on a project, a big box, high bay project, but we have an edge. We know these markets, and there is no other competition, a very, very small amount. So we found the right asset class. And so I would say find an edge in your marketplace where, it's somewhat contrarian to what everyone else is doing. And then also play to your strengths. So for me, it was, I had some relationships that I built over the years to get debt and to raise money and to go out and really help source the deals. And Tim came in, and he really brought in processes, people, procedures, systems, and then also the development background. So I think, don't try to do it all on your own. Try to find your strength. And that's why we get along. I mean, we get into it sometimes. Like he'll say something and I'm like, I don't agree. And then he'll come back at me. And then we'll always end up agreeing to something because we value each other's feedback. But I'm glad I didn't do what he did, and he doesn't do everything that I do. And that's why it works.
Well said. Tim, anything to add, or did he?
He's the talker. He said it perfect.
I gotta earn my money's worth.
That's your strength. We'll put a link to that book in there as well. I did see that actually on your website, and I meant to check it out. Oh, actually, Beverly just put a link to that in the chat. If you have any other questions you want to answer, we've got a couple minutes. I always try to do a hard stop at an hour. So if you do have any questions for Jeremiah or Tim, please put it in the chat. Otherwise, I want to say thanks to Matt for asking some great questions in there. Yeah. Hopefully you got some answers that you wanted. And I saw a guy named B-Rad, which sounds a lot cooler than, I'm guessing it's Brad. I don't know if you recognize it or not. I'm guessing it's Brad. Like, I can't do that. Mine would be C-Had, which doesn't sound cool at all. But Brad, thanks for joining in the comment as well. Gentlemen, thank you so much for hanging out with me today. As mentioned, we'll put those files, the PDFs and the Excel spreadsheet onto the website. I'll post a link to that in the comments shortly after we're done here. And yeah, just really look forward to keeping the conversation going. I'm sure we'll run into each other at a conference or somewhere down the road here in the near future.
Chad, one point on that, I just want to, maybe on future episode, we'll let you know how it all plays out, because the leasing side is where we're really starting to learn our strengths. And that's unconventional now, right? With Facebook Marketplace and even Craigslist and a lot of other ways to lease up these properties. With social media, where you're dealing with real business owners, and you're not just dependent on the brokerage community, which it can be a blessing and a curse. So we're taking our own destiny in our hands and doing some leasing. So we'll let you know how this plays out over the next 6 months.
Yeah, let's even offline, we'll schedule a follow-up on this, because I'd love to have you guys back on. I think part 2 on how everything unfolds would be very insightful. So yeah, let's definitely schedule a follow-up time on that. And really appreciate you guys coming on. The transparency was awesome. If you're watching this and you liked it, please hit that thumbs up button. And gentlemen, we'll be in touch.
Thanks, Chad. Appreciate it, man.
See you, buddy.
Thanks again, guys.
See ya.